Welcome to Ask the Compound, the show where you ask and we answer. I am Ben Carlson. If you're a young investor with many decades ahead of you to invest, should you care if all this AI spending is a bubble? And if you're positive that AI, robotics, quantum computing, all this technology is going to change the world, is it unreasonable to have 30% or more of your portfolio exclusively in tech stocks? We're going to answer these questions and more on today's show. Stick around, please. All right, our email here is askthecompoundshow@gmail.com. On today's show, we'll be answering questions about how you should think about bubbles as a young investor, whether or not someone should go all in on tech stocks in their portfolio, when does it make sense to pay up your 3% mortgage? A lot of questions on this. Do you need to have a home paid off to die with zero? What's the difference between the Buyside and the Sellside? And does it make sense to hold your money in money markets in your fixed income allocation? If you're in the live chat, shoot us off a question. I'm coming to you live from Las Vegas today. I walked into the casino and they handed me a meme stock right when I walked in the door.
Which one did you get?
A couple shares of Rigetti Computing. They had some GameStop shares they were giving away still. It was great.
Nice.
Today's show is brought to you by Rocket Money. In Las Vegas, you need to have a good handle on your budget because you could lose it pretty quick. So you might think you have a handle on your budget. Maybe your spreadsheet says you should have an extra $1,000 left over each month. But if your bank account isn't reflecting that, something's off. Rocket Money is here to help. It's a personal finance app that helps find and cancel unwanted subscriptions, monitors your spending, and helps lower your bills so you can grow your savings. Rocket Money shows you all of your expenses in one place, including all those subscriptions, when they're coming up, bills that are coming up, when you get paid. I use it all the time. I love the app. I love the desktop. Rocket Money has saved users over $2.5 billion, including over $880 million in canceled subscriptions alone. Their 10 million members have saved up to $740 a year when they use all the app's premium features. Cancel those unwanted subscriptions and reach your financial goals faster with Rocket Money. Go to rocketmoney.com/ATC today. That's rocketmoney.com/ATC, or just check out the app on the App Store.
So do you go into a casino with a number in mind of how much you're going to spend? Do you budget?
I budget, yes. I bring in a certain amount, and I say, this is an entertainment budget. And if I lose, that entertainment budget is gone. And guess what? Last night, my entertainment budget was gone. Winning is like playing with house money. So I go into it assuming I'm going to lose all this money. The house has the edge, right?
Yeah, I mean, I think it would be kind of crazy to go in assuming you're going to make money, right?
Yeah, I think some people do, though, correct?
Probably, yeah.
But there's people who think that the stock market is like a casino. But the stock market, if it is, it's the best casino there is because the longer you stay in it, the higher your odds of success. It's the opposite in a regular casino. The longer you stay. But I'm happy if I could play blackjack for 5 hours straight, and I come out at the end of the day, I'm even or I lose money, I'm okay. It's entertainment for me.
Yeah.
I'm not trying to supplant my income.
Makes sense to me.
Let's go. A lot of questions. People calling me out this week. Let's do it.
Okay. Yeah, people are fired up. Up first, we got one from Twitter. What do you do if this is a bubble? This has to be an indicator, right, Ben? We've gotten like 10 bubble questions a week.
It's a lot of bubble. It is a lot of bubble questions. Yes, this is on top of everyone's mind.
Yeah. Okay. What do you do if this is a bubble? Sit it out and maybe miss 2 to 3 years of 30% gains before it gets crushed by 70%? I think it's too costly not to be in the game if your horizon is 8+ years. I think I'm going to let my money sit. This is kind of stream of consciousness. I'm 35. Yeah. If AI isn't a bubble, it means my current livelihood might be having a major disruption, fueling significant gains in my portfolio. If it is a bubble, I'll just keep shoveling money in. If I were older, I'd probably be all over this.
You're right. This is something of someone is trying to think through and let us know what they're thinking and wants to hear our thoughts, right? Here's what I wrote in my book, Everything You Need to Know About Saving for Retirement. I wrote this thing in my late 30s. I said, I have somewhere in the order of 4 or 5 more decades remaining to prepare financially over the rest of my life. In the coming 40 to 50 years, I'm planning on experiencing at least 10 or more bear markets, including 5 or 6 that constitute a market crash in stocks. There will also probably be at least 7 to 8 recessions at that time as well, maybe more, maybe less now. I think I'd like to amend that statement to say there will probably be 4 to 5 financial asset bubbles as well. I love this headline from The Onion. This is in 2008. Put it up there. Recession-plagued nation demands a new bubble to invest in. I love this. It's perfect. So in the late 1990s, you can take that one off, we had the dot-com bubble, right? And we couldn't accept that pain, so we immediately went into a housing bubble in the early aughts. The 2008 financial crisis was caused by a credit bubble, right? I think we were free and clear of bubbles in the 2010s. If anything, it was like an anti-risk bubble because we had the negative yielding bonds and that sort of stuff. 2021 was definitely some sort of meme stock bubble. People were investing in throwing crazy money in NFTs and Bored Apes and remember those Ethereum rocks and stuff. So that was a mini bubble. Now you could claim, and everyone is, that AI CapEx is a new bubble. I think we just can't help ourselves, right? I think this is just kind of the way things are. So the question is, as a young investor, should you care? And I think the person asking this question is onto something. Like, it's not that you should ignore these things altogether, because obviously that's impossible. Like the old adage that you should just ignore the noise, I think it sounds like a great line for financial advisors, and it's impossible today because everyone gets the updates and alerts and everything's in your face all the time. But should you do anything about it? That's the question. It depends on, do you have a reasonable asset allocation in place? Do you have an investment plan in place? Are you investing regularly into the market? Do you have the intestinal fortitude to stick it out when stocks fall and get volatile and keep buying? So I always say that with buy and hold, the buying is sometimes the hard part and the holding is sometimes the hard part, depending on where we are in the cycle. But you have to do both for them to work right, even when it doesn't feel right. So I think this person is right that you should probably be more concerned about a bubble if you're 65 than 35, right? If you're 35, you should hope that sometimes stocks crash so you can buy them on the cheap. I also think you're more likely to make mistakes trying to time these things than you are just sitting them out and building the occasional mania into your financial plan, whatever it is. If you're just going to hold all stocks, be ready for volatility, or you're going to hold more cash or bonds, whatever it is. I think that's the thing. So I do think for a young person, yes, this shouldn't concern you all that much unless you get freaked out by volatility to the upside and the downside.
If you were going to build a bubble, though, it'd be harder to do better than this one, right? I mean, this is because going back to talking about the crypto boom and Axie Infinity and the rocks and all the NFTs, like there were still, I'd say the vast majority of Americans thought that was stupid, right? But I feel like the vast majority of Americans now are using ChatGPT or Gemini or, in Word, whatever,
Yeah, and hopeful to makes them more
using
efficient.
something AI powered. And so this feels a lot more significant.
The question is, like, will this bubble be worth it? Will it make us, all the workers, more efficient? And will it give us all an AI, assistant someday or something like that? Will it all be worth it? I think that's the infrastructure. Is it worth it, right? And like the .com bubble was totally worth it because we grew all the fiber optic cables to have us to be streaming this show right now. Me in Las Vegas, you in Connecticut, right? We built all that out. So yeah, you're right. It's probably going to be worth it, I think.
Yeah,
that's
I use ChatGPT all the time now. It's kind of crazy because even a year ago, I would have been like, I don't need that, But,
my wife doesn't trust anything I tell her, but if I tell her I got it from ChatGPT, then she trusts me.
That's funny. I mean, I do catch mistakes.
Why didn't you tell me you asked ChatGPT? Oh, yeah, it's definitely not right all the time. You have to be careful and fact check but my wife will say, "Oh, I didn't even ask ChatGPT about this." Then definitely, it's like, why don't you just trust me? No, you have to trust the AI.
Yeah.
All right, that's where
the coolest thing is you can. I'll show it a picture of something and say like, what does this do in this old camera or a car or something, and it knows. It's pretty good at that.
Yes,
I enjoy that.
It is. It's pretty neat. All right, let's do another one.
Okay, up next we got
another
a
tech one.
Yeah, we got one from Kevin. I know my judgment might be clouded by the last 15 years, but I have such strong conviction about the technological growth and profits coming over the next 10 to 15 years, driven by AI, quantum computing, and robotics, and aligned with my own investing time horizon, that it's made me seriously reflect on my portfolio allocations. VGT, which is the Vanguard Tech ETF, right?
Yep.
VGT is currently 10% of my portfolio, and I recently made it a goal to increase the allocation to 20%. Talk me out of an allocation of 30%. If I can stomach the volatility and have strong conviction in the future of tech, why would I not do it?
Okay, good. Before we get to this, good question in the chat. Is a bubble more problematic if you invest in just the S&P versus owning individual stocks that can fall 70% or so? I think that's a great question and something you have to think through. All right, so yeah, VGT is the Vanguard Information Technology Index Fund. It's funny because we were getting questions from people from our audience back in 2019, 2020 saying, hey, I'm going to go all in on tech stocks. What do you think? And I think a lot of them did it and are probably feeling pretty good about themselves. But it seemed late cycle then. So obviously timing this stuff is tough. Tech has been on an amazing run. So Daniel, let's do a chart on here. This is a growth of $10,000 in VGT going back to the start of 2010. So decade and a half, call it. $10,000 turned into nearly $165,000 in this period. That's a total return of more than 1,500%, translates into annual returns of more than 19% per year. Like, this is just an amazing run. Chart off, please. So now this week, I wrote another piece about the melt-ups of the past. So Daniel, let's do another chart on, please. So I compared the current run over the last 10 years in the NASDAQ 100 up over 500% to NASDAQ in the 1990s, which was more, it was like 800%. Japan in the 80s, which was right around the same, 500%. And then the Dow in the 20s, which is also around 500%. So this is a historic melt-up move in terms of, if you want to call it bubble activity, whatever, it's right in line with the past. So we're not just in the ballpark. We're sitting next to these guys in the dugout. Chart off, please. So it is kind of crazy. So that's the one thing that would give a lot of people pause is like, oh my gosh, this run has been amazing. It's also true that if you own an S&P 500 index fund, the top 10 names make up 40% of the holdings now. 9 of those 10 are tech stocks, with the other one being Berkshire Hathaway. If you own a NASDAQ 100 index fund, the top 10 stocks make up 54% of the holdings. I'm sure that's pretty similar to that VGT. I'm sure the holdings are pretty similar. Those are all tech stocks, right? So anything market cap weighted in the U.S. gives you a ton of exposure to tech. NVIDIA is almost $5 trillion. Apple's almost $4 trillion. Microsoft's almost $4 trillion. Google is more than $3 trillion. These companies are massive. So I guess my first question would be, what else do you own? If you're already overweight U.S. stocks, you probably have plenty of tech exposure as it is. So on the one hand, it feels kind of late cycle with this stuff because returns have been so strong. On the other hand, it is kind of crazy that we haven't seen how transformational AI is going to be. The robots are coming at some point. Like self-driving cars are going to be ubiquitous. Will that lead to better returns for people? Are we pulling it all forward? I don't know. And it's not like innovation is slowing down. So I think if you're going to do this, you do have to have the stomach for volatility. So someone in the chat asked about individual stocks. Let's do a chart on here of this other one. This is from our guy, Chart Kid Matt at Exhibit A. So he looks at the drawdowns in 2022 and earlier this year in 2025 for Apple, Amazon, Google, Meta, NVIDIA, Microsoft, and Tesla. Those are the Mag 7 stocks. And these are massive drawdowns, right? We're talking about, Meta was down 75%. NVIDIA got cut in half or cut down by 2/3. These individual stocks themselves, if you go on in tech, like it could be painful. So I think what's the right number if you really want to go on in tech? I don't know. I'd say just size it appropriately and make sure you have the ability to lean into the pain somehow if and when these things get crushed, because they probably will at some point, whether it's an earnings miss or an AI bubble or whatever it is. I don't know. Somehow more risk, more reward kind of thing, right? Like these stocks are going more volatile.
It won't surprise you at all to learn that one of my biggest holdings for many years has been a tech ETF. But, years ago, I just thought to myself, in 10 years, are these tech companies going to be more, profitable and more important to the economy or less? And I could never think of a scenario where they're not, other than like a doomsday scenario. So yeah, with the right time horizon, with a long enough time horizon, to me, it always has seemed like, well, yeah, I mean, technology is literally the future, right?
Yeah, it's not going away, and it's such a big part of our everyday lives. And like I said, it's a big part of the stock market now. If you own the U.S. stock market in some capacity, you have a big time exposure to tech already. So leaning into it, I guess, depends how much you already own. But yeah, you're right. All right, let's do another one.
Okay. Up next, we got one from Will. Ben was fired up last week about the guy who paid off his mortgage early. He was almost yelling. I'm 42 and fortunate to be doing well financially. I have $270,000 left on my mortgage at a 3.3% interest rate. I plan to pay it off over the next 10 to 12 months. I would pay the majority of it simply by diverting funds that otherwise would go to index funds in a taxable brokerage account. This may be a not to brag, but I don't think this would meaningfully impact my quality of life. I view paying off my mortgage like a gift to myself. Maybe being 100% debt-free doesn't make financial sense, and maybe it's not necessary, but it's still something I like to give myself. I also like that it would add more diversification to my net worth. Would Ben yell at me for this decision?
Hey, I don't yell. I guess I don't get fired up that often because we had a lot of people saying, man, Ben was fired up about this. It's kind of funny.
You were fired up. Yeah.
Hey, listen, I'm a man of principle. Sometimes you have to put your foot down.
I think you might have even said you'd have to be an idiot, or you used some strong language.
I would never use language. I don't know what you're talking about. First of all, I don't think this is diversifying yourself if you're paying off your house. First of all, like that's concentration risk. You literally live under the roof of your house. If you have more of your money in that house, that's concentration risk, right?
Right. Most people's biggest asset is their house too, right?
Yeah, you're concentrated in your local economy, your job, whatever. Listen, I heard a lot from people who have paid off their mortgages. I totally get it. And this thing was driven by the guy from Twitter who shared that he paid off his 2.625 mortgage, right? And let's be honest, the guy's probably lying. He's probably doing it for clickbait. No, I'm kidding. So this guy paid off his low rate mortgage, and there was two extreme reactions when this guy posted it. One was, why would you do this? Oh my gosh. And the other one was, listen, not all money decisions need to be driven by a spreadsheet. Those are the personal finance. So I heard from a lot of people who paid their mortgage off, and they always say no one ever regrets paying off their mortgage early, right? I get it. It's a psychological thing. Some people need peace of mind. They hate having that debt hang over them. I get it. Debt drives some people up the wall. However, my feeling is that 3% mortgage rates are different. This time really is different. Like maybe we'll see borrowing rates at those levels again, but I think a 3% mortgage or a sub 3% mortgage is one of the best financial assets you could possibly hope for. Inflation is 3% right now. Mortgages are tax advantaged. Your house
That's what I was about to say. Yeah, it's literally below inflation.
Yes, you're borrowing for free on a real basis. Your house is in a liquid asset, so you put money into it, paying it down, but then you can't spend it. All I'm saying is, think of what gives you more flexibility and peace of mind. Paying off your mortgage early and having that money sit in a liquid asset so you don't have the monthly payments, right? Or just parking that money in a money market or T-bills and having a bigger pile of liquidity in case something goes wrong. What's better for you, paying off $270,000 in your mortgage or having $270,000 sit in a T-bill? I think one of them offers you better flexibility and more liquidity. Two makes more sense to me. Now, listen, I think sometimes we take behavioral finance too far. I'm a big behavioral guy. I think behavior is the most important thing for the majority of investors. But I think sometimes you take it too far. Like, hey, listen, if I bury all my money in the backyard, I can sleep better at night. Maybe that's true, but that doesn't help you. Doesn't mean it's a good financial decision. Listen, if your mortgage rate is 5% or higher, I bless you. Pay off that mortgage early if you want. That's a way higher hurdle rate. I just think 3% is different. That's where I stand. And I really think it's a poor financial decision, regardless of how you feel about debt, regardless of how you frame it, about psychology. Sometimes you have to ignore your feelings when making financial decisions. For me, this is one of those times. And guess what? I'm not going to change anyone's mind, so it doesn't matter. Right? Read the next question. Same thing.
What do you think the Venn diagram looks like of people who can't stand having a mortgage, and people who have way too much cash? It's probably the same people, right? Like these are the people that
people are in a good financial position. You're right.
Well, but I'm saying people who also are more like risk averse and go to cash, as soon as there's market turmoil,
yes.
that kind of thing.
I think it is. I think it's a risk thing too. Like I don't like. Listen, if rates go to 3% again in the future, I'm borrowing up to my eyeballs. Give me more money to borrow. I think that's a really smart decision. And if you look at most wealthy people, Mark Zuckerberg took out a mortgage on his house. You don't think he could have bought it in cash? No, it gives you optionality and gives you flexibility.
Yeah.
All right,
so you're not making fun of people, just to be clear. You're not like making fun or calling people stupid for paying off their mortgage if that's what they want to do. But you're just saying if you're looking at the numbers, it does not make sense. If you're really like going
I think that a 3% mortgage changes the equation enough for me to pound the table. And I don't pound the table that often. I'm usually a gray, this exists in a state of gray. Here, do the next one.
Okay. Up next, we got one from Jacob. On one hand, Ben preaches die with zero. On the other hand, he says it's insane to spend... Oh, that was the word you used, insane. Insane to spend money on your home and own it outright. Sounds a little contradictory, but I'd love to get your thoughts. Ben.
Jacob, get out of here. Come on. First of all, I'm not 100% in die with zero. I do lean more heavily in that direction, but here's the thing. You said like the Venn diagram. I'm guessing the Venn diagram of people who pay off their mortgage versus people who don't spend a lot of money, those people overlap a lot. Here's my plan. How about this? Have your mortgage paid off by the time you retire. That's my goal. And again, if rates go back to 3%, I'm probably going to borrow even more, and maybe that goal gets pushed out. But I think that's a worthy goal. By the time you're retired, have that mortgage paid off. How's that?
Yeah, that makes sense. I'm from that cohort of Americans that have so much student loan debt that we're kind of numb to the idea of having a bunch of debt at a crazy rate.
Right? Yeah.
So to me, this sounds like such a first world problem to be like, oh, I'm trying to pay off a 2.8% mortgage or something early. It's like, come talk when you have 7.6%, student loans and crazy.
All right. Someone in the chat says I can't reference Zuckerberg because viewers are normal people that live paycheck to paycheck. That's the point. You need the flexibility more than Mark Zuckerberg does, probably. That's all I'm saying. Yeah. And again, I'm never changing anyone's mind on this.
Value of money.
All right. Next question.
Okay. I just like dropping that because I read it in one finance book. So now I just save it all the time. Okay. Up next, we have a question from Mitch. What's the difference between buy side and sell side? I'm so glad someone asked this because people throw this around in finance all the time, like everyone knows exactly what it means, and a lot of people do not know what it means. So
Yeah,
what
this
does
is
it
like
mean?
a good this is a good inside baseball finance question, right? Okay, so my very first internship in finance, Daniel, throw this up, was on the sell side, and I basically the first day I was there, I asked my boss to explain it to me. It's funny they knew I knew so little about what was going on in the world of finance that they gave me a Wall Street Journal every day and said, just read this. All right, take this off. So the buy side is firms that invest money on behalf of their clients, asset managers, hedge funds, mutual funds, ETFs, private equity. So the buy side manages money on behalf of their clients. The sell side provides research and then facilitates transactions. So that's investment banks, brokerage firms, broker dealers. So the sell side issues and sells securities, the IPOs, they help companies borrow money and issue debt, M&A, all that stuff. So my time on the sell side was for an investment research analyst, and they covered two different fields. One of them was actually tech, and the other one was like industrials. And they offer buy, hold, sell, strong buy, those types of ratings. And the buy side buys that research. And it's funny because people look at the buy, hold, and say like, these people are such idiots, but no one pays for those recommendations, right? They pay for the underlying research of the company and the sector and the trends and the numbers, and that's what they're paying for. So that's the difference. And honestly, the biggest thing I learned working on the sell side is that I wanted to be on the buy side. That's what I learned. I learned what I didn't want to do by working on the sell side.
Okay,
I definitely didn't want to work in investment banking.
So both sides have valuable research, or is one superior for like the average investor?
No,
They have
I don't know
different
how many
incentives, right?
Yeah, yes, there's different career risk involved and different. That's a good way to put it. It's just different things that they're
It
doing.
was Charlie Munger that said, "Show me an incentive, and I'll show you the outcome." Right?
Nailed it.
I think. Yeah.
All right.
Okay.
Next question. We got one more.
Last but not least, we got a question from A. I hold about 8% of my portfolio in cash within a taxable account, primarily in the Vanguard Treasury Money Market Fund. Its SEC yield is approximately 4.25%. Since I reside in California, the income is exempt from state taxes, which adds to its appeal. I consider this cash position part of my overall fixed income allocation, which totals around 30%. The remaining 22% is invested in intermediate term bond funds held in tax deferred accounts. As a retiree, I maintain this level of cash for many of the reasons you outlined: emergency reserves, a buffer against market volatility, and potential dry powder for future opportunities. Does this approach seem reasonable to you? Would you suggest any adjustments?
Okay, first, Matt says hi from Punta Cana. Way to go, Matt. Beautiful area.
Nice.
Do the zip line and enjoy Miami Vice for us.
Oh yeah, that's where you always go.
No, I went there. We went there last year, first time.
Oh, okay. I thought you'd been there a couple of times.
Yeah, cool place. Very nice people. So it is funny to me to think through how many of the questions that we get on a weekly basis are people asking for permission, right? Can I do something like this? Does this make sense? Is it reasonable? And that shows, I think that's one of the reasons, not to like talk about our inside baseball for industry. That's one of the reasons a lot of people hire a financial advisor in the first place or a wealth manager. Like they want someone to help them make the decisions and just do it. Some people can, well, what about this? And what about that? And on this hand, on the other hand. And so some people just need that.
It's also our audience. They're not know-it-alls. They're people that want to learn and want to like, and
which
want
honestly,
feedback
and
that kind of
honestly,
thing.
if you're asking, is this reasonable? And you've probably thought through it pretty good. Like it probably is, right? The people who don't ask the question and just do it, they're the ones who take the risks. And
Right.
like the people who, I mean, there's always a risk of paralysis by analysis and doing too much. But the people who like thought through all the pros and the cons and said, I think I want to do this. What do you think? Like they're probably going to be okay, right? So listen, cash equivalents. So we're talking money markets, T-bills, CDs, high yield savings accounts, that kind of stuff can have a place in your asset allocation, especially in retirement. So this whole idea does seem reasonable to me. I think a lot of people in 2022 in the bond bear market, when bonds got crushed, I think a lot of people, and inflation rose and interest rates rose, I think a lot of people realized like, oh, wait, cash actually can have a place in asset allocation and portfolio management because cash, the yields go up quickly and you don't have the interest rate risk. So a lot of people, especially in an inflationary environment, realize, oh, wow. So actually in the 70s, cash was the best performing investment. It outperformed bonds, it outperformed stocks. I think it's the only time that happened where in a decade basis, it outperformed both of those. So,
and dumb question, I know, but when you say cash, you mean cash in like T-bills or?
yeah.
Okay.
Yeah. Like, yeah, money markets, T-bills, CDs.
Okay.
Apparently you weren't listening to me at first. I feel like I got Michael here now.
I was reading the chat. Sorry.
I know, I'm kidding. So like the Treasury money market fund, I think the only thing you have to be okay with is this strategy, like if and when yields fall. If the Fed keeps cutting rates, these money market yields are going to go down. So are you still okay with the dry powder, with the buffer against volatility, with the steady Eddie approach of these things not moving very much if rates go from 4.25 to, I don't know, 2.5 or 2? Like that's what you have to be okay with in cash. Like that's the trade-off, that the yields could be a lot lower. And so I think you have to but yeah, having a cash piece, again, especially in retirement, I think what they outlined here, it makes a lot of sense. And I think a lot of people want to have that buffer, right? And some people, the way I always get people to think about this is, how many years of spending do you want to have in cash to make you feel good to take risk elsewhere in your portfolio, right? And that risk could be bonds, it could be some alternative asset, it could be real estate, it could be stocks, whatever it is. For some people, it could be, listen, I want 1 year of reserves. For other people, it's I want 4 years or 5 years, whatever the number is. I think having that can actually make you feel better, because in retirement, it feels like you're jumping off a cliff without a parachute, right? You have no more income coming in potentially besides Social Security, maybe a pension. You don't have as much savings to put in if there's a bear market. The sequence of return risk could get you. So I think that, yes, this is reasonable. And if you determine that amount, I think he said 8% of it is. So let's say he's spending 4%. He's got 2 years worth of cash. Is 2 years worth of cash good enough for you to leave the rest of this portfolio alone and rebalance or whatever? Yeah, I think that makes sense as long as you're okay with that risk.
One day we're going to do a show where you just explain all the different bond ETFs to me, because there's so many.
There are a million more
understand.
options now. Yes,
Yeah.
there's floating rate debt, and it's not just treasuries anymore, right? There's a lot of different variations.
Yeah,
yes,
there's
not
a lot.
bad. Jesse in the chat said the chat is much more important than whatever Ben is going on about.
It's true. I mean, it's
The
usually
people
true.
in the chat, they do like talking to each other.
We got almost 2,100 people watching live right now. So
All right,
good
very
audience
cool.
today.
Appreciate everyone who coming in live on YouTube, on Twitter. Remember, if you have a question for us, our email here is askthecompoundshow@gmail.com. You can come in the live chat with us, live every Wednesday, 1 p.m. Eastern. I'm here, whether I'm in Grand Rapids or New York or Las Vegas, wherever. I need to go now because I have to go lose some more money. But hey, listen, I'm following a process. It's process over outcomes, right?
There you go.
All right. Thanks, everyone, for watching. See you next time.
Have fun. See ya.